Welcome to the deep dive and get ready, because we are diving right into what is shaping up to be, well, a truly critical week for global markets. We're talking about an inflection point, a moment where things could really shift, potentially redefining the investment landscape for a while.
That's absolutely right. And the heart of it all, the main event this week, is the Federal Reserve's interest rate decision. And just as importantly, what they say afterwards. This isn't just, another Tuesday announcement. It's potentially market defining. The whole financial world is watching, waiting.
And our mission today is simple. Give you the tools to understand it. We're going to break down how we got here, what we might expect, and critically, what it could mean for you.
Yeah.
We'll unpack the data, the tensions, the possible outcomes, basically cut through the noise. Okay, let's dig in.
Let's do it.
So let's rewind just a bit. The week ending September 12th. If you just looked at the headlines, things seem pretty rosy, right?
Yeah.
S&P 500, NASDAQ, new all-time highs.
They did.
But you mentioned there was a more complex reality underneath. What was really going on?
Yeah, it's fascinating because despite those highs, the market breadth, it was actually quite narrow.
Meaning just a few big names pulling everything up.
Exactly. It wasn't a broad rally. It was mainly those rate-sensitive growth and tech stocks doing the heavy lifting. And interestingly, volatility actually increased during the week.
Yeah.
The market sentiment was just laser-focused on one thing, this idea of a dovish pivot from the Fed. Investors were already positioning, betting on rate cuts coming soon.
Okay, so the market was leaning that way already. What specific data came out that week that really cemented that expectation? Made people think, okay, cuts are definitely coming.
Well, we got the August CPI report. Inflation headline was steady around 2.9%, core a bit higher at 3.1%, broadly in line, so not really a barrier to cuts.
Okay.
But the real clincher, I think, was the weekly initial jobless claims data. It surged, jumped by 27,000 to 263,000. That's the highest since 2021. Yeah. And combine that with some downward revisions to earlier job numbers. It painted a pretty clear picture. The labor market is softening, and maybe softening fast. That really solidified the expectation for a September cut.
So you've got inflation that's still kind of sticky, above target anyway, but the job market is showing cracks. That sounds difficult, like a real policy challenge.
It is. It's the classic stagflationary narrative starting to bubble up again. Stubborn inflation plus slowing growth, maybe rising unemployment.
That's the nightmare scenario for a central bank, isn't it?
It's certainly one of the toughest. Their dual mandate, stable prices and max employment, they start pulling in opposite directions. Cut rates to help jobs, you might fuel inflation. Hold tight on inflation, you might hurt jobs even more. It's a real tightrope walk.
Okay, given that backdrop, the data, the sentiment, how did the big asset classes react? What were the signals?
Oh, the signals were loud and clear. Look at U.S. Treasuries. The benchmark 10-year yield fell, touched that 4.0% level, a 5-month low. And the front end of the curve, like the 2-year yield, that dropped even more sharply, down towards 3.5%. That tells you the market was getting really convinced about near-term cuts.
Makes sense.
And correspondingly, the U.S. dollar index, the DXY, it weakened quite a bit, fell between 97.5 and 97.8. Lower yields, expectation of an easier Fed. That usually weighs on the dollar.
And inside the stock market itself, you mentioned tech and growth-led. What did the sector performance tell us?
It really hammered home that Fed pivot theme. Rate-sensitive sectors, the ones that lower borrowing costs, think utilities, consumer discretionary, and they were the clear winners.
Okay.
But the economically sensitive stuff, the cyclicals like energy and financials, they lagged big time.
So the market wasn't really celebrating broad economic strength at all?
Not really. It was a very targeted bet on the Fed stepping in with more liquidity. It underscores just how much this rally, or at least parts of it, depended on that expectation.
It sounds fragile.
It points to a fragile structure, yeah. Highly dependent on the Fed delivering, maybe even over-delivering on those dovish hopes. And just as a side note, we saw the European Central Bank hold its rates, citing resilience over there. So you're seeing this policy divergence growing between the Fed and the ECB, too.
Okay, so that sets the stage perfectly. All eyes on Wednesday, September 17th. 2:000 p.m. Eastern for the FOMC decision, then Powell's press conference. What are the absolute key things you need to watch for?
Right. The main event, first, obviously, is the rate cut itself. Now, the market has fully priced in a cut. That's not really the question.
How much? Right.
Exactly. How much? The consensus is mostly clustered around 25 basis points, 0.25%.
Okay.
But there's a non-zero chance being talked about for a bigger 50 basis point cut. Some folks like Standard Chartered, for example, are arguing that the labor market data is deteriorating fast enough to warrant a stronger move.
So 25 versus 50. The market reaction could be pretty different depending on which one they choose.
Hugely different, absolutely.
So what else? Beyond the actual number.
Arguably even more important this time around is the updated summary of economic projections. The CEPI, what everyone calls the dot plot.
Ah, yes, the dots, where the committee members anonymously plot their rate forecasts.
Precisely. And the market will pore over the median projection for the Fed funds rate for the end of this year, 2025, and into 2026.
What are they looking for there?
They're looking for the signal. Is this cut just a one-off insurance move because things look a bit shaky? Or is it the clear start of a real sustained easing cycle? How many more cuts do they see coming?
Right. The market seems to expect maybe 2 or 3 total cuts by year end.
That seems to be the general expectation baked in. So if the dot plot comes in showing significantly fewer cuts than that, or maybe only just this one, that could trigger a major repricing. Fast.
Okay, so the cut itself and the dot plot showing future intentions. And then, of course, Chairman Powell steps up to the podium. His words matter a lot.
Absolutely. His press conference is crucial. You'll want to listen for how he frames this decision. How is the Fed balancing that dual mandate tension we talked about? Cutting rates while core inflation is still, stubbornly above target.
How does he justify that?
Exactly. Also, listen for any commentary on the impact of those recent tariffs. Does the Fed see them as a temporary blip for inflation or something more persistent?
Good point.
And finally, watch how he tries to manage expectations going forward. He'll want to sound supportive, likely, but maybe without sounding too dovish, to avoid letting financial conditions ease too much, too fast, which could just reignite inflation later. It's a communication tightrope.
Okay, so Fed is front and center. But the rest of the week isn't exactly quiet, is it? The economic calendar seems almost designed to immediately test whatever the Fed says.
It really is. It's quite a gauntlet. On Monday, before the Fed, we get the NY Empire State Manufacturing Index, first real read on September manufacturing. If that comes in weak, it sort of pre-validates a Fed cut. Then Tuesday, the day before the Fed, we get August retail sales. Hugely important. How's the consumer holding up?
Right. If sales are strong, it kind of undermines the need for a cut.
They could challenge it, yeah. Or at least challenge the need for a big cut or lots of future cuts. But if retail sales miss badly, it confirms the Fed's worries, but might also ramp up recession fears. Double-edged sword, that one.
And then after the Fed decision on Wednesday,
we get hit with more data almost immediately on Thursday. Another round of initial jobless claims, are they still rising? Philly Fed manufacturing survey, and August housing starts.
So more chances for the market to react. If that data is weak,
then it's probably seen as bad news is good news for markets hoping for more easing. Reinforces the dovish case. But if the data holds up surprisingly well, you might see some of those dovish bets unwound a bit.
And it's not just macro data. We've got some key companies reporting earnings, providing that ground level view.
Exactly. Real-time checks. On Wednesday morning, before the market opens, General Mills reports. You'll be looking there for clues about the consumer. Are they still spending? Trading down. What about input costs?
A window into the pantry, basically.
Kind of, yeah. Then Thursday after the close, a big one, FedEx. Global shipping volumes, their guidance. It's a key barometer for global trade, especially with all the talk about tariffs.
Definitely one to watch.
And also Thursday after the close, Lennar, the home builder. Vital read on the housing market. New orders, cancellations, how sensitive are buyers to mortgage rates now? Really important stuff.
Okay, so this brings us to the big picture scenarios. The market comes into the week really leaning one way, expecting cuts, expecting dovishness. But that sets up a real tension, doesn't it?
It absolutely does. A huge tension. You basically have two main interpretations battling it out. Scenario one is the Dovish Easing Cycle.
The one the market seems to want.
The one it's positioned for, yeah.
Right.
Maybe they cut 50 basis points, or they cut 25, but the dot plot is super dovish. Powell sounds very accommodating.
What happens then?
Well, it validates the current market positioning. You could see growth stocks rally further, the dollar weaken more, maybe gold catches a bid. It fits that soft landing narrative where the Fed guides the economy down gently.
But what's the catch?
The catch is, because it's so widely expected, how much upside is actually left. You run that buy the rumor, sell the news risk. The reaction might be positive initially, but maybe it fades.
Okay. So what's the other side? The risk scenario.
The main risk is what we're calling the hawkish cut. This is where they deliver the expected 25 basis point cut.
Okay.
But the dot plot shows maybe only 1 or 2 cuts total this year, not the 3 or more the market wants. And Powell in his press conference sounds really cautious, emphasizing the inflation fight, downplaying the need for much more easing.
Signaling they're cutting reluctantly, almost.
Exactly. Like, okay, the labor market forced our hand this time, but don't get used to it. Inflation is still the priority.
And the market reaction to that.
That could be sharp. A real sell the news reversal. You could see those dovish trades unwind quickly. Bond yields could spike back up. The dollar could rally strongly. It would catch a lot of people off guard.
Okay, let's make this really concrete. How do these two scenarios, dovish easing versus hawkish cut, play out for specific stocks people might own or watch? Like, say, NVIDIA or FedEx?
Right. Good question. So for NVIDIA, NVDA, Tesla, TSLA, those high-growth, high-beta names, their valuations are super sensitive to interest rates, to the discount rate.
Right.
So a dovish signal, especially on the long-term rate path, that could fuel another rally. But a hawkish surprise, that could hit them hard, trigger profit taking.
Makes sense. What about the economic bellwethers like FedEx or Lennar?
Their earnings on Thursday are like a reality check after the Fed speaks. If FedEx, FDX, comes out with weak guidance on global trade, or Lennar, LNNN, signals housing demand is really faltering, that could amplify recession fears, even if the Fed was initially dovish.
So their reality could override the Fed's message.
To some extent, yes. Conversely, if they deliver strong results, it bolsters that soft landing argument. For banks, like JP Morgan, JPM, it's all about the yield curve. A dovish cut that steepens the curve is generally good for banks. A hawkish reaction that flattens or inverts it, bad for banks.
And defensive names, like United Health.
Yeah, United Health, UNH, is a good example of a defensive stalwart. Its relative performance tells you about risk appetite. If the market goes risk off after the Fed, UNH should hold up better, outperform. If it's risk on, it might lag the racier names.
One more ExxonMobil. Oil seems complicated here.
Exxon XOM is complex. A dovish Fed often means a weaker dollar, which can be good for oil prices. But if the Fed is cutting because the economy looks really weak, that signals lower future demand for oil, which is bearish, so it's a push and pull. Demand worries might outweigh the weak dollar effect.
Wow. Okay, and just to add one more layer of chaos. Friday is quadruple witching. Sounds spooky. What is it, and why does it matter this week?
Yeah. The name is dramatic. It's simply the day, once a quarter, when 4 different types of futures and options contracts all expire on the same day. Stock index futures, stock index options, single stock options, single stock futures.
Okay, so lots of contracts settling. What does that do?
It usually leads to a big spike in trading volume, especially near the end of the day. And it can increase volatility. Now, normally it's just a technical event, but this Friday, coming right after such a potentially massive Fed decision...
It could amplify things.
Exactly. It has the potential to pour fuel on whatever trend emerges post-Fed. If the market is selling off, quad witching might accelerate it. If it's rallying, same thing. It just adds another layer of potential fireworks and unpredictability to end the week.
So wrapping this all up, it's a huge week, tons of moving parts, high stakes. For our listeners trying to make sense of it, what's the key takeaway? How should you be thinking about positioning?
Well, look, given how much the market seems to have already baked in that dovish outcome, there's a real asymmetry here, I think. Meaning, the potential downside, if the Fed delivers that hawkish cut scenario, seems, to me at least, larger than the potential upside if they just deliver the dovish outcome everyone already expects.
Because the good news is priced in, but the bad news isn't.
Pretty much. So a prudent approach might involve maybe trimming some exposure in those high-flying, rate-sensitive names that have run up into this event, and just generally being prepared for volatility to pick up, maybe significantly. It feels like a time to be a bit cautious, given how one-sided the bets seem to be.
This week really does feel like a genuine inflection point. So much hinges on the Fed's decision, the dots, Powell's exact words. Every detail is going to be scrutinized.
Absolutely. And understanding how all these pieces fit together, the global picture, the company earnings, even market mechanics like quad witching, that's going to be crucial for navigating whatever comes next. The anticipation is sky high.
Yeah.
But the actual path forward, still very much up in the air.
So the final thought then. Given how much a dovish Fed seems baked into market prices already, what does it actually tell us about the real economy? If the Fed doesn't deliver exactly that, what might they be seeing that the rest of the market is maybe ignoring? That's the question to keep asking. Keep watching, keep learning.
Well said.